In 1988, Warren Buffett spent $1,300,000,000 on a single stock. Not a tech company, not a startup with some revolutionary idea, a soda company, Coca-Cola. People thought he had lost his mind. The stock market had just crashed. Nobody was buying anything. But Buffett walked in and put over $1 billion into a company that sold sugar water. And here is where it gets strange. That $1,300,000,000, by 2025, it was paying Buffett $816 million every single year in dividends alone, without selling a single share. Every hour, his Berkshire Hathaway earns $93,000 from Coca-Cola while he sleeps. He had already gotten his entire original investment back in dividends, twice over. Now here's the question nobody asks. Could he have made more money putting that same billion into Amazon, a growth stock that paid zero dividends and reinvested everything? The answer to that question is not what you think. And by the end of this video, you will know exactly which type of stock belongs in your life and why getting this wrong is one of the most expensive mistakes a new investor can make. Let us start with what these two things actually are, and I want you to picture two farmers. The first farmer has a mature apple orchard. Every autumn, without fail, he picks apples and sells them. He sends you a check every quarter. The orchard does not grow much bigger, but those checks never stop. That is a dividend stock. A mature company, think Coca-Cola, Johnson & Johnson, Procter & Gamble, that takes its profits and hands a portion back to you regularly. The second farmer just planted a mango grove. He does not pick any mangoes yet. Every time a mango grows, instead of selling it, he plants 3 more trees. The grove is getting bigger every year. One day, if everything goes right, that grove could be worth 10 times what he paid for it. That is a growth stock. Amazon, Apple in its early years, Nvidia before the world knew what a GPU was. These companies keep everything they earn and plow it back into growth. Now here's the truth that most people completely miss. Most beginners think this is a battle. Dividends versus growth. Pick a side. They read something online, they pick one, and they dig in. That is not how it works. The real question is, where are you in your life, and what does your money need to do for you right now? Think of it like planning a road trip. Before you pick your car and your route, 3 questions decide everything. First, how far are you driving? Are you going across the country, a 3-day journey, or just to the next town, 30 minutes away? That is your time in the market. A 25-year-old is driving across the country. A 60-year-old is driving to the next town. The farther your destination, the more aggressive your route can afford to be. Second, do you need rest stops along the way? If you are solo, fully fueled, and you can go straight through, great. But if you have people depending on you, asking every hour, are we there yet? We need food, we need gas. You need stops. Those stops are your dividend income, regular, predictable, along the way. If your investments are your only source of income right now, you need those stops. If you have a salary covering your life, you can drive straight through and let the money compound. Third, what kind of road can you handle? A smooth 6-lane highway is comfortable for anyone, but the fastest route to the biggest destination sometimes runs through mountain passes. Narrow, steep, no guardrails. In 2000, Amazon stock dropped 94%. That is not a pothole. That is driving off a cliff and somehow landing back on the road 3 years later. Can you handle that road without turning back, or does your stomach demand the highway? How far do you need stops, and what road can you handle? Answer those 3 questions honestly, and you already know which type of stock belongs in your life right now. And here's what 20 years of watching real investors taught me. Most people skip these questions entirely. They pick stocks based on what sounds exciting, instead of first figuring out which road they're actually on. Now let us go back to Buffett and Coca-Cola, because this story has a twist. When Buffett bought Coca-Cola in 1988, the dividend yield was modest, about 2 or 3%. Not exciting. But Coca-Cola raised its dividend every single year for the next 63 years in a row. Not sometimes, every year, even during recessions, even during financial crises. So what happened to Buffett's yield? He paid roughly $3.25 per share. Today, Coca-Cola pays $2.04 per share in dividends annually. That means Buffett is earning a yield of over 62% on what he originally paid. Not 2%,
62%. Think of it like a rental property. You buy a house for $100,000, the first year it rents for $800 a month. Modest. But the rent goes up every year. 20 years later, it rents for $3,000 a month. You're not earning 3% on $100,000 anymore. You're earning $36,000 a year on the same $100,000. That is what dividend growth does over decades. In his 2022 letter to shareholders, Buffett wrote about exactly this. He noted that in 1994, Berkshire received $75 million in cash dividends from Coca-Cola. By 2022, that number had grown to $704 million. He wrote, "Growth occurred every year, just as certain as birthdays."
Now let's go to the other side. Jeff Bezos launched Amazon in 1997 at $18 a share. Amazon has never paid a single dividend, not 1 cent. Instead, every dollar the company earned went back into building warehouses, cloud servers, delivery networks, and new businesses. If you had invested $1,000 in Amazon in 1997, by 2025, that investment would be worth over $2 million. Amazon shares have returned close to 187,000% since that IPO. No dividend check ever arrived, but that mango grove, it became a continent. So now you're sitting there thinking, obviously, I should have bought Amazon. And that is exactly the trap, because here's what those numbers do not show you. Between 2000 and 2001, Amazon stock fell 94% from $113 to $6. If you had invested in early 2000 at the peak, you sat in a 94% loss for years. Most people cannot do that. They sell, they panic, they take the loss and walk away. Meanwhile, the person holding Coca-Cola in 2001, their stock dipped, but the dividend check still arrived every quarter. The orchard kept producing apples. They held on, they collected, they compounded.
This is the scientific truth behind why dividends matter more than most people think. A landmark study by Hartford Funds and Morningstar found that going all the way back to 1960, 85% of the cumulative total return of the S&P 500 came from reinvested dividends and the power of compounding. Not from stock prices going up, from dividends being reinvested and snowballing over decades. That is not a small number, that is most of the game. And separately, research from Ned Davis Research found that from 1973 to 2023, dividend-paying stocks returned 9.18% annually. Non-dividend stocks returned 3.95%. Over 50 years, that gap does not look like a gap, it looks like a canyon. So why does anyone buy growth stocks? Because time changes everything. If you were young, if you have a 20 or 30-year runway and you can survive the stomach-dropping crashes along the way, a concentrated bet on true growth companies can build wealth faster than almost anything else. Amazon, Nvidia, Apple, these are not myths, they are real. But they require patience, conviction, and the ability to hold when every headline tells you to sell. If you are older, if you are approaching retirement, or if you simply need your investments to generate income right now, dividend stocks are not the boring option, they are the intelligent option. They give you the apple harvest every autumn without having to sell the orchard. Here is how I want you to remember all of this. 2 farmers. One with a mature orchard sending you checks every quarter. One planting a grove that will be worth a fortune in 20 years. Neither farmer is wrong. The question is, which one matches where you are standing today? Most beginners need a mix of both. Start with quality dividend growers as your foundation, companies that have raised their dividends for at least 25 consecutive years. Then allocate a portion to growth if your time horizon and risk tolerance allow it. And whatever you do, never chase the highest dividend yield you can find. A company paying a 10% dividend yield is almost always screaming that something is wrong. A company paying a 2% yield and raising it every year for 30 years is quietly building your future. Buffett said it best when describing what he looks for in a business, something that a 100-year flood cannot wash away. Coca-Cola has been paying dividends since 1920, 105 years without missing a payment. That orchard is still producing, and it started with $1,300,000,000. And a man who believed that the best investment is one you never have to sell.